Welcome to the XFO Intelligence Podcast, where we explore breakthrough ideas and unconventional strategies that can reshape the future of wealth. Today we're tackling the 10,000% problem, the architecture of asymmetric wealth, and the art of capturing the 100x return. There's a stark reality in equity markets. Fewer than 1% of all listed stocks create the majority of wealth over decades. These outliers, known as 100 baggers, appreciate 10,000%, turning a $10,000 investment into $1 million. Conventional wisdom tells us these moonshots are nearly impossible to identify. But the greatest misconception is that finding them is the hard part. The truth, identifying a potential 100-bagger is far easier than holding on through its full life cycle. That's because the real challenge lies in portfolio architecture. It means building a structure that can capture and hold those rare compounding rides. So what makes a 100-bagger? These companies follow certain non-negotiable principles. First, total addressable market expansion. These are firms that don't just win in a static industry. They create or drastically expand markets. Think companies turning non-consumers into consumers, or unlocking entirely new industries. Second, the monopoly bottleneck. These companies erect structural barriers, controlling nodes in a supply chain, or leveraging zero marginal cost net worth effects. This is where high return on invested capital proves their competitive moat. The next generation of 100-baggers will likely emerge from frontier sectors, commercial orbital economies, embodied AI and humanoid robotics, synthetic biology, and next-gen energy infrastructure fueling the AI revolution. So why do most investors miss the ride? Because traditional finance is wired to prevent it. The de-risking dilution trap demands rebalancing away from the best performers, capping potential upside. The valuation anchor makes investors sell too early when a stock looks overvalued by trailing metrics. And then there's volatility. With 100-baggers, gut-wrenching drawdowns, 50 to 70%, aren't outliers. They're crucial. They flush out short-term holders, transferring shares to those with conviction. Surviving the valley of death, the 5x to 10x zone, requires absolute faith in that expansion thesis. The solution? Asymmetric portfolio architecture. This means embracing a barbell approach. The bulk of your capital, 85 to 90%, goes into ultra-safe assets. The rest, 10 to 15%, is a basket of small bets in paradigm-shifting frontiers. Expect 80% to fail, but the few winners, you let them run. No traditional trimming. It's not about making one lucky pick. It's about creating a system, an engine that concentrates capital into the rare winners, while continuously fueling new exploration. It means using liquidity reserves not as dead money, but as shock absorbers, deploying into proven moonshots during volatility. Most crucially, you ruthlessly concentrate on the winners as they mature. Let them swell to 20% or more of the portfolio, ignoring rebalancing rules. Over time, apply an exploration tax, skim profits from maturing giants, and recycle them into the next explorations. Beyond structure, there's time arbitrage. The market thinks in quarters. 100-baggers compound over decades. Holding them isn't about prediction. It's about following a strict algorithmic rulebook. Prune if the fundamental thesis breaks. Thicken positions when the thesis accelerates. And buy more during panic-driven drawdowns. Ultimately, this is structural engineering, not a guessing game. By abandoning the linear mindset of traditional investing and embracing the nonlinear realities of compounding, you transform volatility from a foe into the fuel for generational wealth. Thanks for listening to today's episode. If you found value, please like, share, and subscribe to the XFO Intelligence Podcast channel. We'd love to hear from you. Email us at xfointelligence@gmail.com for feedback, or to request information about our new Thought Leadership On Demand service. Disclaimer: this podcast is for informational purposes only, not financial advice. Always do your own research.